Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. President Biden urges on his negotiating team as House Speaker McCarthy signals a debt ceiling deal could be struck this weekend. Stock futures in the U.S. are higher. G7 leaders are meeting in Japan as they weigh more curbs on Russia. Sources tell Bloomberg Volodymyr Zelensky will attend. We're live in Hiroshima. Plus, Fed officials sound increasingly split over policy at next month's meeting, prompting traders to lift bets for a hike. So we have a packed show looking at the busy week that we've had. But first thing is first, let's also check on the markets. This is the picture for European stocks. We did also have a rally in the Nasdaq yesterday, certainly above that 52 moving average, weekly moving average. European stocks gaining 0.5%. The thinking there is, of course, if we don't have some kind of debt ceiling overhang, or certainly not a cliffhanger, then stocks are poised to make more modest gains, as there was a little bit of profit taking ahead of something ugly happening in the U.S. I'm looking at mining, financial services really leading gains in Europe. Most sectors in the regional benchmark trading higher. And then the picture is also dollar strength, a little bit lower than it was just 20 minutes ago. And the Brent crude, we had a good conversation with the head of commodities at Bank of America. Brent 76.39. Now, there's not huge regional difference when you look at Europe as a whole, because, of course, a lot of this is only on margin calls and or actually margin profit in some of the earnings, some of the big earnings that we saw in the U.S. And so that's really filtering through quite equally to some of the indices. You can see the FTSE gaining 0.3%, the DAX 0.5% higher. Now, President Biden and House Speaker Kevin McCarthy have indicated a debt limit deal could be reached as soon as this weekend. Now, the optimistic tone from both sides has raised hopes that Congress will act in time to avoid a U.S. default. So let's now get straight to our Bloomberg senior editor. He's Bill Ferries. Bill, first of all, how optimistic should the markets be at this point, given that, what we're hearing from President Biden and Kevin McCarthy?
Well, the tone of the talks has definitely improved, both sides saying that some sort of an agreement could come, or at least the outlines of an agreement could be reached by the end of this weekend. That would give negotiators time to hammer out a lot of the details that still have to be worked out before as early as the June 1st ex-date, when the U.S. is scheduled to hit that debt ceiling.
So is there, Bill, honestly, in politics, anything could derail the agreement. But is there any big hurdle that you're worried about?
Well, yeah, you don't have a deal until you have a deal. And there's still going to be a lot of the details that have to get worked out. I think we're going to look very carefully at how some of those Republicans to the right of Kevin McCarthy, several of whom have never voted to raise the debt ceiling in their entire political careers, how they feel about the agreement. And also, President Biden is getting some flack from progressives on his left, who are very concerned that he's going to negotiate away too much of what they've considered to be non-negotiable issues, such as work requirements for people on government aid. So those kind of things could start to pull the center apart a little bit. We need to see the details of what the final agreement is.
I was going to ask you, what does the final agreement look like?
Well, so, the big question, I think, will be how far down the road do these sides kick the can in terms of the debt ceiling? When will the next debt ceiling limit be? When Republicans first offered to enter talks, they proposed a debt ceiling increase that would last about a year. That, of course, would take those negotiations right into the middle of the presidential campaigning season. And it gets a lot harder to reach an agreement when both parties are trying to stake out of a position. So that's the big thing that we still don't know. How much will they raise it by, and how long will that last?
Bill, as always, thank you so much for joining us. Bill Ferries there on the debt ceiling. Now, we're also joined by Dana El-Battaj, Bloomberg's managing editor for credit in EMEA. Dana, thank you for joining us. You always make us smarter on credit, and there's, of course, a direct link. If you're a company and you need to issue some of the debt, do you look at the debt ceiling and say, look, I'm going to do it now just in case?
Absolutely. Usually whenever you want to price debt, you want to make sure that there isn't that much volatility out there. So right now, over the last 2 weeks, people have been waiting on a decision. There hasn't been that much bad news out there. So corporates have been hitting the market as hard as they can with as many deals as possible. This is the time to price debt. Once we know that there is a deal, there's going to be some volatility. And after that, you can probably price something, but you don't know when the next big headline is coming. That's why over the last 2 weeks, it's been nonstop in the primary world.
Yeah, of course, you just want to do it with the most favorable conditions possible.
Absolutely.
Talking about favorable conditions, I mean, we heard from Lori Logan, president of the Federal Reserve of Dallas. I mean, she put a bit of a curveball because she was much more hawkish. She's a voting member than what we thought. What does that mean for credit?
Look, there's always going to be ups and downs until we know what's going to happen with inflation going forward. Even if the rate is slowing, it's still well above what the target is. And so for that reason, you will always have hawkish comments like that coming and going. Until there is some certainty over where inflation is headed, it's not a surprise that there is some hawkishness out there.
We're seeing an equity rally, and our John Author has also wrote a brilliant piece explaining it. China putting a little bit of a spanner in the works in all of this. Do we need, I mean, how does that end?
Well, the thing is that if you have the risk of a global recession, the last thing that you want is the world's second biggest economy faltering and its post-COVID rally basically slowing. You don't want that. You want them to want more products. You want them to, you want them to keep the price of oil up and so on and so forth. So I think the issue with China and the reason why so many people are worried about the recovery in China is because the reality of an economic recession globally becomes more and more real if the slowdown there really takes hold.
Dan, is there anything else that you're looking at? I mean, some of the dynamics, for example, between equities and credits and how they've, played, and that's really changed the last couple of years. Do we go back to what it was like 5 years ago, or has that dynamic changed forever?
I think right now what we're seeing is an entirely new market, and we are swaying back and forth. And at this time, I think people obviously they want yield. They want to make money, but they want to make money knowing that they're not going to put it in a security that's going to go down because of a default or so on and so forth. So yes, bonds have benefited significantly because of this demand for safe assets. Also, the fact that rates have gone up means that safe bonds are now offering some really interesting yields. So yeah, there are outflows from equities into bonds, but even within the bond world, it has been extremely complicated. Junk bonds are not as sexy as they used to be. Investment grade bonds is where the money is headed, and I think that we will continue to see that.
I mean, I want to do a whole program called "Junk Bonds Are Not as Sexy as They Used to Be." Does it really depend regionally on where a lot of these companies are making their money?
It is very idiosyncratic, and this is the time when an analyst's job is so important. There was a time where you could throw your money at pretty much anything, and you would make money. Now you have to dig deep into the finances.
There you go. A lot of analysts actually having to earning their fees. Dana, thank you so much for joining us. Dana Al-Battaji, they're, of course, our managing editor for Credit. Coming up, G7 leaders consider tighter sanctions on Russia as they meet in Japan. So we'll discuss that next. And this is Bloomberg.
Japan is what I refer to as the supply chain of the supply chain. There are about 18, 19 companies here in Japan that operate 40 to 75 to 80% of market share worldwide in their space. You cannot produce a semiconductor without a Japanese company involved in it, if not multiple companies.
The U.S. ambassador to Japan there, Ram Emanuel, speaking to Bloomberg in Hiroshima as Micron strikes a deal with Japan for financial aid to make chips. Now, Bloomberg has also learned that the G7 will increase pressure on Russia with extra sanctions on restrictions of goods. Now, that's as Ukrainian President Volodymyr Zelensky is set to be joining world leaders at the G7 in Hiroshima. Bloomberg's Rosalind Matheson joins us now. Roz, you're in the bunker. I know that there's like a lot going on. You're basically just writing headlines and trying to break news. So, congratulations to all of the Bloomberg team that have been doing really an outstanding job in covering the G7. When you look at what leaders can do to reinforce some of the sanctions on Russia, is it shadow banking? Like, what can they touch to lock these in?
Well, that really is the fundamental question, because you look at the depth and breadth of the sanctions that have been put on Russia so far, and they're pretty extensive, and yet the Russian economy has remained somewhat resilient, and certainly Vladimir Putin is not being deterred at all with his war in Ukraine. So a big question here is what else can be done? What else can be squeezed that's not already been touched? Of course, a lot of conversation around existing loopholes in those sanctions regimes. A lot of countries have not signed up to the sanctions. So many goods that are going through third countries. And of course, Russia continues to export energy to a lot of other countries around the world. We do know there's going to be a tracking mechanism around Russian diamonds, for example. That's the first step, perhaps, towards banning what is a very lucrative trade for Russia. We also know there's going to be some tightening of those loopholes, particularly, again, equipment that's going through third countries into Russia. But in terms of sort of the overall ability to squeeze the Russian economy, it really does come down to money. And right now, Russia retains heavy reserves that can sustain for months on the go. So shadow banking even is not going to do anything. Certainly, as long as you've got that money coming in from China, from India, from the Middle East and elsewhere, there's very little that can be done to stop Vladimir Putin in terms of at least his actions on the ground in Ukraine.
Where does this leave us with China? If you're going to hurt Russia, does the G7 need to get closer to China?
Well, certainly what we're expecting here, in fact, is tougher language on China. If anything, that the language they use here is economic coercion, and that's code for what they say are the economic practices, in particular of China. And what we know, there's going to be a broad mechanism here where the G7 nations will agree to coordinate their policies when it comes to China. They can't agree exactly what those policies should be and how tough to go, because, of course, even with all this talk of self-sufficiency, you can see that these nations are still very intertwined economically with China, but certainly the rhetoric seems to be hardening, and the idea you could pull China away from Russia and into their orbit seems to have dissipated entirely. If anything, the China-Russia relationship is only deepening.
Roz, we're also, of course, hearing that the president of Ukraine could be attending the G7. How significant would that be?
Well, it's significant on two grounds. One is, of course, we're in Hiroshima, which there was a nuclear bomb dropped on this city in the dying days of World War II. And that's very poignant for Ukraine also in many ways. The Russian president has threatened to use nuclear weapons on Ukraine. He plans to move some of his arsenal very close next door in Belarus. And of course, there's the memory of Chernobyl, which was a nuclear power plant. But of course, that meltdown that happened decades ago and the impact that had on what is now Ukraine. So, of course, it's very much intertwined into the Ukrainian experience right now. So the pictures of the Ukrainian president standing here in ground zero, essentially, for Hiroshima will be very powerful indeed. And also coming here gives him the chance to engage what's known as the Global South. These are countries outside the Group of Seven. Of course, he's got very firm support from the G7, but what he's looking for is kind of that support from countries like India, Vietnam, Africa, Brazil, and so on. So it's a chance really to meet with those leaders here.
Roz, first of all, how important is this summit for Japan and for the Prime Minister in particular? But also underlying this is everything that's happening with chip makers and the fact that a lot of the G7 countries are trying to find alternative sources to Chinese chips.
Well, we've seen some interesting deals on the sidelines here, particularly in that regard between the UK and Japan. But of course, this is a good moment for the Japanese Prime Minister. His popularity has been rising again after a bit of a dip. Hosting a summit like this is good for his popularity, as was his visit, of course, to Ukraine not that long ago. And as well, it gives him a chance to showcase his ability to negotiate in the region. He's hosting, of course, the South Korean president on the sidelines of this meeting. That's a really important relationship in the region, but one that's been very tense for many years. And so that's going to be important, particularly again for Japan, as they look to ways to contain North Korea, another country that's got a budding nuclear arsenal. So, of course, there's lots of things here for the Japanese Prime Minister where he can say, look, I've hosted this summit and I brought a bunch of people together, and that's only positive for him.
Roz, thank you so much for all of the insight. Of course, Rosalind Matheson there for us at the G7. You can see that well-established badge that, of course, a lot of our top editors have to wear to get around these big summits. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The UK is committing £1 billion to boosting its domestic chip industry over the next decade, focusing on areas like research and design, where it already has a comparative advantage. The investment is a fraction of what other governments have pledged as they look to reduce reliance on Asia. The US and EU say they plan to spend more than $90 billion between them on this sector. Now, Bloomberg has learned the ECB is stepping up scrutiny of banks' liquidity reserves and may communicate stricter requirements to firms later this year. The ECB's annual review of the risks faced by banks is likely to pay more attention to the management of liquid funds. That comes in the wake of the collapse of Credit Suisse and US lenders, including Silicon Valley Bank. Japan's inflation has re-accelerated after months of cooling, with CPI, excluding fresh food, hitting 3.4% in the year to April. Underlying prices, which also exclude energy, rose at the fastest pace since 1981. The data is likely to move the BOJ closer to policy normalization. And billionaire investor Sam Zell has died. Zell was known for his bets on distressed assets, calling himself the grave dancer. He built a fortune in real estate, but also invested in disparate business, including radio stations, drugstores, parking lots, and mattress makers. He also made a losing bet that drove the parent company of the Chicago Tribune into bankruptcy. Sam Zell was aged 81. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
Leanne, thank you so much. Coming up, UK telecom bosses cutting thousands of jobs over the coming years. What does this mean for the telecoms industry? We'll discuss that next. And this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, BT and Vodafone are both heavyweights on the UK's FTSE 100, and both fell on news of major job cuts this week. So where has this earnings season left a wider UK investment case? Well, joining us now to discuss all of this is Tim Craighead. He's Bloomberg Intelligence Senior European Equity Strategist. So, Tim, thank you so much, as always, for joining us. How have earnings fared so far?
So, couple things I would mention on the heels of your telecom comment. I would say I think that's much more of a European affair than it is necessarily a UK affair. And interestingly enough, we did just step up and make Vodafone a focus idea because we think that there is an underappreciated opportunity here for restructuring. But set that aside. On earnings, it's been a really interesting first quarter earnings picture in that broadly across Europe, we've had much better than expected results. 15% earnings growth is now what's recorded for the overall European market. Minus 1% was initially expected. But if you look at what's transpired with revisions going back to the UK, the advantage that the FTSE had last year, which was dramatic, has now almost totally slipped away. Revisions are down a couple of percent year to date in the UK. They're up 4% for the Stock 600.
So I'm fascinated by telecoms. So what I don't understand is that if you look at the world's richest men, like 5-10 years ago, it was Draghi, it was Carlos Slim. It's all people that made money in telecoms. Xavier Niel, also the French billionaire. And now it's really tough environment. Like, what's changed? They're splitting off. Is it just because it's so disrupted?
Well, I think part of it is disrupted. Part of it is there's a ton of investment that needs to go in to bring the infrastructure up to speed. And part of it is, it's a very diverse set of companies here in Europe that hasn't consolidated, and unlike, say, in the US, and that makes a difference. Part of the reason why we think this could be interesting over the course of the next 2 years is that finally maybe we get to where we consolidate down to a smaller number of operators that can be profitable.
Okay, and I know there's also sale of Millicom. Okay, we'll talk a lot more about telecom. Talk to me about the investment case for the FTSE. Is there one?
Well, so yes, but.
Yes, but is a no.
Exactly. I mean, I think that there's a mainstream bearish argument right now politics, lingering Brexit hocus pocus and whatnot, set all of that aside. We're not particularly optimistic on the FTSE through this year, unlike where we were last year, because of really composition. We were enthusiastic last year because financial profitability was expanding with rising rates. Energy, which there's a ton of it in the FTSE, was expanding with rising energy prices. And staples and healthcare are really big, and they were defensive. All that turns on its head this year. Net interest margin story is probably now done. You've got energy that's fading. And the staples and healthcare are okay, but they're global and they're taking pressure from a strong pound. And so a lot of the positives that made the FTSE a haven last year are sort of, they're just not there. We don't see downside, we just don't see the upside.
Tim, thank you so much, as ever, really, for all of your analysis. Tim Craighead, Bloomberg Intelligence Senior European Equity Strategist. Coming up, we'll dive into the U.S. debt ceiling debate with Leslie Vinjamuri, Director of the U.S. and Americas Program at Chatham House. President Biden urges on his negotiating team as House Speaker McCarthy signals a debt ceiling deal could be struck this weekend, while stock futures are higher. G7 leaders are meeting in Japan as they weigh more curbs on Russia. Sources tell Bloomberg Volodymyr Zelensky will attend. Plus, Fed officials sound increasingly split over policy at next month's meeting, prompting traders to lift bets for a hike. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Bloomberg has learned that the ECB is stepping up scrutiny of banks' liquidity reserves and may communicate stricter requirements to firms later this year. Let's get more on this Bloomberg scoop with our Nicholas Comfort, our European finance reporter. So how much, Nick, and this is an amazing scoop, how much does this have to do with the banking turmoil, SVB, but also what happened to Credit Suisse?
Yeah, I'd say definitely the ECB scrutiny of liquidity accelerated with the banking turmoil in the US and with Credit Suisse here in Europe. I mean, it's something they've been looking at in some detail since the end of 2021 with inflation. But I mean, they really ramped that up when they saw just how bad it can get for banks. The impact of rising rates can be quite detrimental to banks as well. It's not just a positive in terms of earnings.
So, Nick, what businesses is the ECB likely to be focused on?
Yeah, as we understand it, the areas they'll be looking at most closely sort of in the autumn of this year will be wealth management and also sort of the banks that are exceptionally funded on financial markets, so bond investors. But also, I mean, we always think of retail being super stable in terms of liquidity, but actually, that's one area where supervisors are questioning as well, saying, hey, just how stable is retail? Could we be seeing if depositors lose confidence for some reason in their banks or in the overall system in which they're based in? Should this be an area which we're more focused on as well? Digital technology plays into that as well. People can move money much more quickly these days than they could do in the past.
So are European banks in the same situation as the U.S. firms that went by? I mean, regulation's different, right? And I keep on getting told, look, there's regulation and then there's supervision. Like, are we just in a different boat, or could there be similarities? We know, we also spoke to Jamie Dimon on short sellers 10 days ago. Yes,
good point, Francine. It's really important to differentiate here. First of all, the banks in the U.S., which were, I mean, smaller than JPMorgan certainly, but still pretty big banks, they weren't subject to the same standards of liquidity regulation as all European banks are. So they didn't have to meet the so-called liquidity coverage ratio, which is very important. And then also beyond that, the ECB says that the euro area banks have less exposure in terms of interest rate risk in the banking book as well. So there are key differences here. But I don't think the ECB is willing to run the risk of being asleep at the wheel on this one. And they really want to make sure that in their supervision, they are taking account of the risks of rising rates and of tighter monetary policy. Those TLTROs, they're disappearing as well in coming months. So they don't want to lose focus on that.
Nick, thank you so much. Nicholas Comfort, our European finance reporter there with the very latest on this wonderful, important Bloomberg scoop. Now, there's some cautious optimism in the markets as a deal to raise the U.S. debt ceiling appears to be getting closer. Well, President Biden earlier urged his negotiators to keep pursuing an agreement after House Speaker Kevin McCarthy indicated that a deal may be struck by the weekend. Let's speak to Leslie Vinjamuri, director of the U.S. and Americas program at Chatham House. Leslie, you always make me smarter on U.S. politics, so thank you so much for coming in. I don't know whether we were so downbeat about, politicians in the U.S. being able to agree anything, that this is now a huge surprise that they're dealing with the debt ceiling so quickly. Is the optimism warranted?
I would hate to guess wrong. It certainly looks like they're heading towards a deal. I think for many people who watch this closely, there's been an assumption that this would go to the brink and then be dialed back. But obviously, for everybody watching, both at home in the United States, but especially around the world, and the world is watching, this is an extraordinary brinkmanship play, and one that really hurts the credibility and the leadership of the United States. Remember that President Biden is at the G7 in Japan right now and trying to focus on the big global challenges, on the war in Ukraine, on security in the Indo-Pacific, and many other challenges. And, right behind his shoulder, everybody's asking him, are you going to resolve this problem? Because the implications globally would be obviously very, very significant. This is a president also, Francine, who's had to cut his international travel short as a result of the crisis at home.
So, Leslie, what does a deal look like at this point? And is it a deal for, the 1st of June or the 2nd of June or wherever the debt ceiling is, or is it something that could be more substantive?
I think that is the looming question. First of all, I think that it's likely. It sounds like it's likely that it will go for a vote as early as next week. Obviously, the president, the country, the Democrats would like this to be a deal that extends beyond 2024. The idea that this would be a short-term deal that would drive this conversation right into the midst of an election year is one that I think everybody would like to avoid. And there's a question of, how much the president and the Democrats will concede when it comes to the budget. Some of that unspent COVID money is likely to be one point of concession. But we are going to see a president who's going to have to very skillfully manage all sides of his party. Obviously, the progressives in the Democratic Party are mobilized against this being linked to budget cuts. Pressing for, other measures to be used to resolve the crisis. But I think in the end, we will see some concessions. And it's to everybody's advantage to move out of this space, not least the president, who, again, is in Japan at that G7, has canceled his meeting, his travel to Australia for a meeting of the Quad, canceled a visit to Papua New Guinea, which the country had declared a national holiday. Because the United States president was turning up. I mean, the implications for America's leadership are very significant at a time when this president is really trying to focus very clearly on the Indo-Pacific and on America's leadership role with respect to China.
Leslie, I know you don't have a crystal ball or inside a politician's brain, but you're close to that. So is this because the debt ceiling, right, could really be catastrophic if there's a U.S. default? Or do you see softening on both sides and trying, to, I guess, normalize U.S. politics and finding more of a compromise in general?
I think this is pretty clearly about the debt ceiling and the cost at home to many people who would lose, many people that are critical to both parties' constituencies, obviously to America's global position, to many countries, to the financial system. So I would hesitate to say that this was about trying to find a new normal in American politics at a time where that doesn't seem on the cards. We are about to see probably DeSantis declare that he's running for president as early as next week. The heating up of intense partisan politics that are, as we know, deeply polarized, I don't think is something that's going to change in the near term.
And of course, we're in an election cycle. I don't know whether you think DeSantis, or whether it's too soon to say, is going to be the Republican nomination, and whether actually it seems that China bashing from all sides is going to be the thing that will harden as we get close to the presidential election in the U.S.
You know, on the candidate question, it is very difficult to say because, of course, it depends on many things. What happens with Donald Trump and the various cases that he's dealing with. In the short term, he's had a bump. That's partly, I think, why DeSantis has waited. But there are multiple candidates, and so there's a big question about whether those votes get divided on the Republican side, and that could help former President Donald Trump, as we know. But your very important question about China policy and whether there's what we might call an outbidding to see who can be tougher on China, that seems to be the case, certainly in the Congress. But we've seen from the White House and in general in the last few weeks a real effort to moderate the language that's coming out of the United States about its approach to China, to try and find some point of diplomatic engagement, to talk about de-risking, not decoupling, to stress the need to have a productive relationship. That's going to be a harder line to hold to as we get more fully into that election year. But again, we are seeing many people come out in favor of a more careful and moderated approach that is attentive to the national security risks of economic engagement, certainly on technology, on artificial intelligence, but that really seeks to dial down some of the tensions.
Yeah, Leslie, thank you so much for some really important conversations on China. Of course, so some of the curbs on technology would be on top of the Trump-era tariffs on Chinese imports, which, frankly, President Biden has largely kept in place. Leslie Vinjamuri there, director of the U.S. and the Americas program at Chatham House. Coming up, why Japan's streaming addiction is posing problems for the yen. This is an important conversation. We'll bring you that story next, and this is Bloomberg.
On the AI side, we created a number of years ago what we call a responsible AI division, where we're bringing in experts internally, but also bringing in experts from external as well, to be able to kind of look around the corners and think about what are some of the challenges that will come up, what are some of the areas that we need to think about and we need to bake in. So yes, that's a really important part of the company and the roles that we have.
What are the pitfalls coming up in AI? Because we try and read as much as we can, but actually if you're not in it, it's extremely difficult to see what our lives could be like in 5 years with AI.
Yeah, so look, we are going through another moment in technology that I find very exciting. You know, you get one of these every few years. And what we're seeing now is really going to change again how we live, how we work, how we come together, and the skills that people are going to be able to have. From a meta perspective, there's kind of 3 key ways that we're using. And we've really been using AI since the earliest days of newsfeed back in 2006. So we use it to bring to the top the things that you want to see from your family, your friends, the brands, etc. We also use it, the large machine learning models, to be able to take down the bad content, the misinformation, we get it out. And then we also use it from an advertising perspective as well, to be able to connect the advertiser with the right person that they want to be able to reach. And now we've just started to talk about some of the things that we're going to do and the ability now to actually create advertising or changing. So say I'm a florist selling these flowers, very nice backdrop in this picture, but maybe I'd like to see a green background, a blue background, a red background. You can do that now. Maybe you want to change the nature of the shot. This shot was taken like this. Want to pull it out to be able to use reels. We'll now start to be able to do those sorts of things. So still really early days, but it's very exciting where this is going.
What do you worry about? I mean, of course, we all talk about fake news, fake pictures, and so far you can tell actually the difference, right? The Pope with a puffer jacket was something that people went, and then after 15 minutes, maybe saying, no, that's probably not true. But as this gets more sophisticated, it'll get harder.
Yeah, so one of the things that we're thinking about is very much around, there's conversations around IP, where that resides. There's conversations around the labeling. So those are the sorts of things that we're bringing into the company that we're thinking about now and we're trying to get ahead of, and also making sure that we're taking things and we're training the models now where we do see something that is, for example, a piece of misinformation, that we can label it, take a digital fingerprint of it, and then be able to take it down off the platform. So that we're actively making sure that we're looking at these sorts of things.
Meta's Global Business Group head, Nicola Mendelsohn, speaking exclusively to us at Bloomberg's New Voices London event. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Disney is closing a luxury hotel in Florida amid a high-profile fight with Republican Governor Ron DeSantis. The company is also ditching plans to relocate 2,000 staff from California to a new $800 million campus it was building in the state. Now, Bloomberg has learned that Britain is close to winning a major battery plant for electric vehicles. Tata Group, the Indian parent company of Jaguar Land Rover, is said to be leaning towards choosing it over Spain. The plant would make batteries for the company's planned range of fully electric models that are due from 2024. The Times reports the government offered Jaguar Land Rover £500 million to locate here in the UK. A group of TikTok creators are suing Montana after it became the first US state to ban the short video app. The lawsuit says the ban, signed this week, violates First Amendment rights to free speech. The plaintiffs include users who earn income from the platform, who say they've made life decisions based on it. And ChatGPT is coming to smartphones for the first time with the release of an iPhone version of the AI tool. The software has been released in the US with plans for more countries in the coming weeks. The app allows users to ask questions to the chatbot through typing or even speaking. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
Leanne, thank you so much. Now, Japan's streaming addiction is turning into a structural drag on the yen. That's according to analysts at Barclays. They say the rising flow of Japanese money overseas to pay for services like Netflix and Amazon is knocking the currency. Let's bring in Bloomberg's Paul Dobson with the very latest. Paul, this story is fascinating, right? So why is Japan's so-called digital deficit a problem for the currency, the yen?
Yeah, so fun one for a Friday, Francine. The Barclays guys have been looking into Japan's current account and figuring out that actually it has this really big kind of deficit, this big outflow that's becoming persistent and growing for what it calls IT services or digital deficit. So when they dug into what exactly that meant, they found the Japanese are paying billions of dollars for subscription services to stream video, for music, for electronic books, for internet advertising, and so on. And it all adds up to something that's, equivalent to about $35 billion of payments going out of the yen and into the dollar and other currencies. So, that has the effect of putting a little bit of a downward pressure on the yen when everything else is balancing out, a bit of a hole there in the accounts, and so that's why they see it as something that could be, a negative and a permanent drag on the yen because it's not going away anytime soon.
So, Paul, the yen's fallen more than 5% against dollar this year. What's the outlook from analysts at Barclays?
Yeah, well, unfortunately, it's not all it takes to determine the currency, according to Barclays. So they're actually pretty bullish for the yen over the coming year. They think that inbound tourism is going to have a much bigger impact than this digital deficit that they're talking about. Plus, they see the potential for the BOJ to start tweaking its yield curve control some more later in the year. So they're looking for some appreciation towards the 123 by the end of Q1 next year. So quite a long way from where we are at the moment, around the 138 level. So doesn't have that huge a bearing on the overall direction of the currency, but it is something that is interesting to note, Francine.
Paul, thank you so much for all of that reporting. Paul Dobson, of course, in Asia for us. Coming up, Greece prepares for an election this Sunday. What should we expect? We'll discuss that next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, we're getting a bit of breaking news out of the G7. The G7 will work to further curtail Russia's use of the financial system. We had a terrific briefing from Ross Matheson, who's, of course, in charge of the event on the ground. She's in Hiroshima for the G7. And he was saying, of course, when you look at some of the things that they can do, it's also shadow banking and trying to curb some of the things that Russia so far has been able to do in terms of the financial system. Now, Greece prepares for an election this Sunday as its economy rebounds, nearing where it was before the debt crisis. Unemployment has more than halved from its peak of 28%, but austerity's painful legacy still cuts deep in the country. Paul Tugwell, our deputy bureau chief in Athens, joins us now. So, Paul, what's expected in terms of results? It seems to be a very difficult and fraught election.
It is, but polls over the last few months have been pretty consistent in showing that the centre-right New Democracy Party of the current Prime Minister, Kyriakos Mitsotakis, will place first. But he's not seeing winning enough votes to be able to form a government on his own, and that's because these elections will take place according to a proportional representation system, which makes one-party government quite hard to achieve. That change was introduced by the former Premier Alexis Tsipras, who's leader of the leftist Syriza party. What does that mean? It means that the only way we can have a government from these elections is for a coalition. Mitsotakis is dead set against that. He's an advocate of a single-party government. Tsipras is willing to form a coalition, but he would need the third largest party, the Socialist PASOK party. But the leader of that party, Nikos Antolourakis, has said that Tsipras cannot be prime minister for him to join a coalition. What does that mean? It means the Greek president, if she wants, can invite the party leaders of all parties in parliament to form a grand coalition. If she thinks that wouldn't be a worthwhile exercise, then we would go to a second election sometime in early July. What changes? Why that's important? Why do we care? Those elections would take place again on another electoral system that would give as many as 50 bonus seats to the party that comes first. Under that scenario, based on recent polls, Mitsotakis could possibly just fall short of an overall majority or have a very slim majority. And that would, depending on that result, would give the possibility of some instability at that point.
But the concern, I guess, Paul, is that, you know, this was an economy that really had to reform and went through painful process. What does this, all of the uncertainty, the possible, you know, coalition forming mean for the economy?
Sorry, I didn't quite hear the last part of your question.
What does this mean for the economy? What's at stake?
In terms of the second elections, what really is at stake there is whether Greece will be able to regain, as markets expect, investment grade this year. Greek government bonds are trading at a level similar to Italian bonds, and obviously Italy has investment grade. Greek stocks this year so far being amongst the best performers in the world, and Greek economic growth is above the Eurozone average. If the country is able to obtain investment grade, that would, of course, open up the door for more investment into the country. As many investors, investment funds only invest in investment-grade countries. But they obviously will wait, the rating agencies, to see what happens after the second elections before making a decision on that. And that also is important to get that grade because it would help economic growth even further, and would also help Greece to continue to reduce its level of debt. It saw the biggest reduction in GDP ratio to debt last year.
Yeah, Paul, so we'll, of course, follow that election very closely. Paul Tugwell from Athens. We'll have plenty more throughout the day. Bloomberg Surveillance continues in the next hour. Sonali Bazek in New York, Anna Edwards here in London.
I think we're right in the middle of that sweet spot. You are in this sort of limbo where the data is not clear-cut. For us, that is perfect.
For clients, you simply try to monitor markets that are sending you conflicting messages. The equity market is essentially saying, well, this is business as usual. The bond market is pricing fears.
I think we're going back to something like the 80s and 90s. We're going to go back to like a stock-picking, rotational type of market. It isn't so much, is the S&P going to go up? It's which sectors and which stocks are going to perform.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Bloomberg's learned that Ukraine's President Zelensky will travel to Japan to visit the G7 summit in person. The leaders there will focus on toughening up sanctions against Russia. President Biden's pushing his negotiators to keep pursuing a deal to raise the debt limit. House Speaker McCarthy indicates there could be an agreement by this weekend. And a change at the top of Lazard, the investment bank that's been hit by a slump in deal-making. CEO Ken Jacobs plans to step aside and be replaced by Peter Orszag. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Sonali Basak in New York. Kriti Gupta is off today. Sonali, it is very good to have you with me this Friday. And we're focused on two things, really, aren't we? We're focused on the G7 on the one hand. We're also focused, and that's the geopolitics of the day. We're also focused on those Washington debt conversations. Wall Street taking its cue from Washington, and the mood music has improved over the last couple of days.
It has improved, but if you take a look here, Anna, we are looking at mood music that has not improved that much in the bond markets. There's still a little skepticism baked here on what a debt ceiling really looks like when we look at negotiations over in Washington. But let's take a look. We do have optimism here in S&P futures. We are seeing them rise in conjunction with some strength over in European equities. We are looking them up at about 0.2%. Nothing too crazy here, but some green on the screen is nice after a very tough couple of weeks for the S&P, kind of flat for a couple of weeks here. The two-year yields, however, we are looking at a 422 handle, and if you look at that, that is down a little bit from the levels we saw yesterday, but much, much higher than we saw last week. This is the week of the fours. We have broken that 4% level, but 422 headed into the weekend shows you there's still a bit of jitteriness under the surface in those debt ceiling talks. Now, the Bloomberg Dollar Index in conjunction with the yields lower on the day, but again, it has been stronger all week. Crude also here, Anna, getting a lift, looking at 72 on the day heading into the weekend.
And let's have a look at where we are on Europe then, Sonali. We've got European equity markets gaining, but really this is a little bit yesterday's story. This is the optimism we saw on Wall Street going around the globe through Asia and into the European session and pushing European equities higher. As a result of that, we have some of the high beta sectors doing pretty well today, from technology to the auto space. Most sectors actually in positive territory this morning here in the European session. Financial services also, private equity names, some of those doing pretty well. UBS on the rise as well. So this is the picture. European equity markets are moving higher. Let's pick out the German market as an interesting area today, because it looks as if we could be getting a record close on the German DAX. That's certainly what it looks like from the middle of the morning here, European time. We're up by 0.7% on the DAX. Clearly, the reopening in China has been a big driver there, and also a better than expected winter, given our expectations for winter were really tough going into it. So all that has helped the DAX to recover. This is the Greek 10-year yield. I put this in because we have an eye on Greek politics this weekend. There's a vote, a leadership election taking place on Sunday. And what's at stake here from a financial markets perspective is whether Greece is going to be able to reclaim that investment grade rating. And that could make a real difference, because we see 4.037. That's what it yields right now, actually below where Italian debt of a similar tenor trades. So that is interesting. But that's what we're watching for in terms of the Greek story, economically at least. And this is Ubisoft. This is a corporate story here in Europe. French game maker, that stock down by 4.4% after their numbers and after a downgrade from one of the brokers. And I also have oil for you, Sonali. 76.19 is where we trade, also up around 0.4%. Bank of America talking about a supply deficit in the second half of this year.
Anna, we're going to go back to U.S. geopolitics here, because we know that Ukraine's President Volodymyr Zelensky will travel to Japan to join G7 leaders in person. Officials have added an extra session to the summit's schedule on Sunday to accommodate his schedule. Bloomberg's Anne-Marie Hordern broke the scoop with Jenny Leonard. Anne-Marie joins us now in Hiroshima for more. Anne-Marie, what can we expect out of his appearance at such a tense time?
Well, this is just a deeply symbolic move, given the fact that it's happening here in Hiroshima. That is where he is going to address the G7 leaders, right here in the city that today President Biden and other leaders visited the Peace Park, and they saw the destruction of the first ever nuclear weapon that was dropped on this city some nearly 80 years ago. And it comes at a time when Putin is waging war on Zelensky's country of Ukraine and periodically uses the threat of using atomic weapons in Ukraine. So there's deep symbolism to this journey. But of course, what we do know is that Zelensky has been touring European capitals. He was in Rome, he was in London, where Anna is, and he's been asking for more ammunition and military support as they're going into this counteroffensive. The other big topic, of course, when it comes to Russia's invasion of Ukraine is how this group is continuing to monitor the sanctions they've laid on Moscow. One thing they want to do is shore up some of the holes and the loopholes that Russia has in obtaining some material they need to continue this war.
Right, so the focus in terms of policy against Russia then on shoring up those loopholes, as you say, Anne-Marie, and perhaps taking some action, but not an entire ban on Russian diamonds. Moving away from the details of what is being talked about at the G7, I'm sure President Biden also thinking about what's going on in Washington. Take us through the latest on the debt ceiling.
He certainly is. And this morning, very early Japan time, evening U.S. time, he spoke with his key negotiators who are now dealing with the Republicans to try to hammer out this agreement. And he sounded very optimistic. And he said to them, continue on these negotiations. And it comes on the heels that you have Speaker McCarthy saying potentially there could be a deal emerging in principle over the weekend. And then Senator Schumer leading the Democrats in the Senate, saying, I may have to call back senators next week for a vote. So what you are hearing is positive mood music, whether it's Hiroshima or whether Washington, D.C., about finding a compromise between Republicans and Democrats when it comes to lifting the debt ceiling. But we should also cage this and have a little bit of a grain of salt. We did hear from Patrick McHenry. He's the chair of the Financial Services Committee. He's a key ally of Speaker McCarthy, and he said there is not a deal just yet, but it does look like it's moving in the right direction.
Bloomberg's Anne-Marie Horderin reporting from Hiroshima. Thank you so much for your time and great scoop. Fed officials are sounding increasingly split over whether to raise or pause interest rate hikes at their next meeting. While Dallas Fed Chief Lori Logan suggested she's not ready to pause tightening, Governor Philip Jefferson made the case for patience.
That monetary policy works with long and variable lags, and that a year is not a long enough period for demand to feel the full effects of higher interest rates.
Bloomberg's Valerie Teitel joins us now for more. Valerie, just an incredible amount of Fed speak this week. Not to forget Powell speaking just this afternoon. What is sticking out for markets?
Sonali, yesterday it was definitely these Logan comments that rocked markets a bit. They were very hawkish, probably the most hawkish we've heard in quite a few weeks from a Fed official. And remember, she is a voter. She came out saying that the current data doesn't justify a pause, and she hasn't seen the progress yet that they need to make in order to rein in inflation. Now, two-year yields moved higher on this. Now, a lot of people say the fall in treasuries yesterday was more to do about the debt ceiling optimism, but I think if you all think this is the debt ceiling, you're missing the main point here. The premium for the June hike yesterday hit 40%, and we can't forget we've had some strong data out of the U.S., including jobless claims yesterday and retail sales, all causing the two-year yield to rocket 30 basis points higher in just the last few sessions. And with this, guys, it makes almost the NASDAQ rally yesterday even more impressive that it's doing that in the front of higher two-year yields. Now, we do have more Fed speak to come today. We hear from John Williams in just a few hours, but that's not to overshadow. We hear from the man himself at 11 a.m. today. Jerome Powell will be on a panel with Ben Bernanke. I think given these hawkish comments from Logan yesterday, if we don't hear something dovish from Powell today, the market might take that in stride and begin to think that a June hike is a real possibility.
Okay, well, so much for the pause. We'll see if we get back to that conversation. Valerie, a Bloomberg scoop here in this part of the world reporting that the ECB's annual review will likely pay more attention to banks' management of liquid funds. The collapse of Credit Suisse has appeared to heighten concerns. So what do we know so far about this? I mean, neither Credit Suisse nor SVB or the other regional bank chaos happened on the ECB's watch, but why is this affecting their policy?
Look, it's clearly hitting some sort of nerve within the ECB that they might need to act on it. It's part of their annual review that this Bloomberg scoop says that they're going to put more scrutiny on banks' liquidity positions, especially when it comes to their liquidity coverage ratio and their HQLA. That's their high-quality liquid asset requirements. Now, this review is not due until the middle of the year, and it doesn't expect it to be actioned upon until the fall. That being said, it needs to be said that the European banks, the weighted average liquidity coverage ratio of European banks stands substantially above the ECB's minimum. So I'm not sure there's a direct market impact for banks right now, but it's interesting to note that the ECB is scrutinizing it.
Valerie Teitel, thank you for your time. Now we're going to move over to a big shakeup on Wall Street. Lazard CEO Ken Jacobs is stepping down amid a slump in deal-making and a plunge in the company's stock price. Jacobs will step aside and he will be replaced by Peter Orszag. Joining us now to discuss this is Bloomberg Finance editor Michael Moore. Mike, thank you for joining us because this is a very big move, but there has been somewhat of a succession plan in place here. How surprising is it to see this transition over at Lazard?
I think, if we go back to when Jacobs took the job in 2010, it was right after Bruce Wasserstein died. He was seen as kind of this emergency appointment, and to be here 13 years later with him as one of the longest tenured leaders on Wall Street, it's been quite a run. So from that perspective, it's not surprising. Lazard's share price has struggled amid the deal slump. Therefore, it makes some sense for this to be a period of change.
And Michael, let's pivot slightly to another area of financial services. We've heard from Robin Grew, the newly appointed CEO of the world's largest publicly listed hedge fund. She spoke on Bloomberg's Masters of Business podcast in her first interview since taking the role.
The firm is brilliant. I mean, it has a cracking core business. And my number one job, apart from anything, is not to break that, because that is value and it's real and it will continue to grow.
A really fascinating podcast there, which you can find on the Bloomberg terminal and elsewhere. But what did you take away from the conversation? She talked really in interesting terms about the way you recruit for hedge funds and financial services. But what did you take away in terms of how she runs the business?
Yeah, I mean, she really preached continuity here. They've been on a good run in terms of attracting assets in what's been a tumultuous period, not just for markets, but for the broader asset management industry. They've kind of defied that. They've been steadily bringing in assets, and it seems like she does not want to break the momentum there with any major changes. But it'll be interesting to see once she's been in the role for a little longer if she makes some tweaks around the edges. She did talk about AI, and she seemed fairly bullish there, talking about how the fears are overblown and it can make a difference for some companies. So that will be interesting how that starts to creep into the asset management industry.
Yeah, and on the theme of continuity, she did talk about how the business has used and will continue to use technology, and also the M&A strategies development in the United States got a specific mention. Michael, thank you very much for that. Bloomberg's Michael Moore with the latest on those financial services themes. Coming up on the programme, we'll get back to a markets conversation. Myles Bradshaw joins us, JPMorgan Asset Management, Global Head of Aggregate Fixed Income Strategies. A great person to talk to about the debt ceiling, where that takes us, and his latest hawkish commentary coming to us from the Fed. We'll also speak to Annika Trion, Chief Economist at Van Lanschot Kempen. We'll talk global economics, but also investment strategy. Plus, Deere is out with results before the US market open. More on what to expect from the tractor maker ahead. This is Bloomberg.
Bloomberg Surveillance Early Edition. I'm Sonali Basak in New York with Anna Edwards in London. Now, the credit crunch has fueled a record pace of restructurings this year. Just in the past week, we saw 7 notable companies file for Chapter 11 bankruptcy protection. And billionaire investor Mark Lasry, who specializes in distressed debt, told me there's more to come.
You're going to have more bankruptcies. You're going to have more problems. That's why the Fed is going to lower rates, right? They're going to have to. And then the question is it a mild recession? Is it a hard recession? I think it ends up being a mild recession because the economy is doing well, but you're going to need more money into the system. That's why the Fed will lower rates.
Joining us now is Dana Al-Baltaji, Bloomberg's managing editor for credit. You know, when we look here at the wave of bankruptcies we've already seen, what can we expect ahead, given that there are still so many recession fears?
I think exactly as it was expressed before, you're going to see more of the same. At the end of the day, when you have a tight credit market and companies can't raise debt, and appetite for companies whose finances aren't exactly 100%, quite low. I mean, there was a time when you could find an investor that could invest in you if you can't really tap the market for cash, but now is not that time. We're seeing a crisis of valuation, and we're also seeing investors within the credit world that have no appetite for companies that really should not have survived this long anyway.
Yeah, that's interesting, and interesting to shine a spotlight on what we're seeing there in terms of bankruptcies. Dana, thinking about the companies that are coming to market and raising money, those that are in the market's good books, if you like, they're seeing a window, or they have seen a window up to now, up to maybe next week, where there's a lot of focus on the X-date and the debt ceiling conversations in Washington, and getting corporates just wanted to avoid having to raise cash around that period.
I think corporates have learned a very important lesson over the last year or so, and especially over the last 3 months, which is that if there are no big headlines and if volatility is low, you sell. Sell as much debt as you can, try to tap the market, because that window will close. And I think that's exactly what we saw within the US and European markets. The primary markets have been super hot. And so I think next week, when there's a decision, if there is one, you might see a slowdown as volatility shakes the market a bit. But I think for the rest of this year, you will see this sort of trend. When there is a window of opportunity, you'll see a flood of issuance with people trying to get cash while they still can.
How are investors, especially debt investors, really thinking about the impact of the U.S. debt ceiling debate here? Are there more risks that are under the surface that could impact issuance in other markets?
Of course, one of the things, I mean, obviously, if the U.S. defaults, then all bets are off. But if the U.S. doesn't default and there is a deal, then one of the possible risks is that you could see a flood of issuance on the T-bill side from the U.S. And if that were to happen, what you could see is a tightening of liquidity among banks. That in and of itself could be problematic for the corporate debt market, because if banks don't have more capital, basically, to deploy within the markets, then the cost of borrowing starts to go up. Liquidity is absolutely key here.
Okay, Dana, thank you very much. Dana El-Battaji joining us there from Bloomberg, of course, with the latest on credit markets. And you can read more about these stories and more in The Brink, Bloomberg's twice-weekly newsletter detailing corporate bankruptcies, distressed debt and turnaround stories globally. This is Bloomberg.
This is Bloomberg Surveillance, early edition. I'm Shonali Bassick in New York with Anna Edwards over in London. Now, keeping you up to date with the news from around the world, here's the first word. The U.S. and Taiwan have agreed to increase their trade relationship, and it's the first tangible results from an initiative that faces vehement opposition from China. The Taiwan Initiative isn't a formal free trade agreement and doesn't address thorny issues such as tariffs, but it still clouds the outlook for a visit to the U.S. next week by a Chinese commerce official. Over in Montana, a group of TikTok creators has sued to challenge the first statewide ban of the popular video app. A bill signed into law this week will prohibit TikTok's download by the general public, and the suit claims, among other things, that Montana is banning speech it doesn't have the right to suppress. Another development for Disney as the company engages in a high-profile fight with Florida Governor Ron DeSantis. The world's largest entertainment company is dropping plans to relocate 2,000 California workers to new corporate campus it was building in Florida. Disney is also closing a luxury hotel at its Orlando amusement park. And a new report from Barclays says a Netflix addiction is turning into a structural drag on the Japanese yen. According to strategists, Japan's so-called digital deficit stems from payments to overseas tech companies such as Netflix and Amazon. And they say its continued expansion will put pressure on the yen. Anna, how remarkable there that you do see such a large global company weighing on one of the largest global currencies.
Yeah, absolutely. I mean, to be fair, it's not just Netflix, it's payment for all kinds of streaming, whether that's music or video, but it is an incredible thing that has an impact on your country's currency. I'm sure Japan is not alone there. Thinking about Japan, we have G7 leaders, of course, meeting in Japan, Shonali, and we're just getting live pictures of the G7 leadership team visiting the Itsukushima Shrine in Hiroshima Prefecture. They're having this tour. They're going to have a group photo later, as these things often do, with a working dinner later on today. A lot of the work so far and the commentary has been around around Russia and Ukraine, as you'd expect. The G7 calling earlier, reiterating earlier that they want Russia to unconditionally withdraw from Ukraine, wanting to reduce Russia's use of the international financial system, close any loopholes there, as we heard from our colleague Anne-Marie Hordern earlier on. They've also said earlier they think the price cap on Russian oil is working. So G7 leaders enjoying that tour perhaps right now. Earlier in the day, they visited the site of the Hiroshima nuclear explosion, of course, and so a nuclear attack. So they will certainly have that in their minds as they consider all things Russia-Ukraine. More on the markets when we return. This is Bloomberg.
This is Bloomberg Surveillance Early Edition, and here is what you need to know. Bloomberg has learned that Ukraine's President Zelensky will travel to Japan to visit the G7 summit in person. The leaders there will focus on toughening up sanctions against Russia. Now, President Biden is pushing his negotiators to keep pursuing a deal to raise the debt limit. House Speaker McCarthy indicates that there could be an agreement just this weekend. And a change at the top of Lazard, the investment bank that has been hit by a slump in deal-making, now has a CEO, Ken Jacobs, planning to step aside. He will be replaced by Peter Orszag. I'm Sonali Basak in New York with Anna Edwards in London. Kriti Gupta is off today. Anna, what are the markets looking like over there?
Yeah, well, European equity markets then catching up really on yesterday, in a sense, Sonali, catching up on the session on Wall Street yesterday, the positivity, the risk-on mood we saw there, all connected to the debt ceiling debate. But the Stocks Europe 600 up by 0.6% right now. Most sectors in positive territory as we go through this morning. Financial services, private equity, those kind of high beta sectors doing pretty well today. The DAX is interesting. It looks as if it's on course for a record close on that German index. The fact that we've seen Chinese reopening has played well for Germany, and the winter not being as bad as it could have been given the issues around energy supply. All of that has added up to a period of strength for the DAX. Now, the Greek 10-year yield is unchanged. The reason I put this in here is just to flag that we have an election taking place in Greece on Sunday. And one of the things from financial market perspective that is at stake is whether Greece is going to reclaim, many, many years after the euro crisis and the debt crisis in Greece, whether it's going to reclaim its investment grade credit status. And we will see whether that happens. Interesting that this percent that it trades at, this yield it trades at, is actually a little lower than the one attached to Italy right now, to BTPs at the 10-year. So that's interesting. Brent crude is 76.58 right now, up by a whole percent, Sonali. So actually gaining momentum through this last hour or so as we watch oil markets. Certainly Bank of America talking about further upside for oil prices in the second half of the year, given driven by supply deficits, they suggest. What do you see on U.S. futures?
Yeah, absolutely. When you're looking at New York crude as well, you're looking at almost 1 percentage point higher as well. But really, you're seeing a lot of action here and a cooling of the 2-year yield, and that's what's interesting me the most today, because you did have that big rise above 4% this week, but you had it about 4.25 yesterday and now down to about 4.21 today. The U.S. dollar index cooling in conjunction. You have S&P futures looking a little higher on the day, but not that much, about 0.1%, a little more than that. Nothing to cry home about, but it is a green day today in the U.S.
OK, let's get into a markets conversation. Myles Bradshaw joins us, JPMorgan Asset Management Global Head of Aggregate Fixed Income Strategies. Myles, really nice to have you with us. It seems that the mood has improved a little around the whole debt ceiling debate in the United States. The short end of the Treasuries market has been taking this kind of seriously for the last few weeks, maybe more seriously than equities. But I want to ask you about how you're approaching the debt ceiling in the short term. How are you, what conversations are you having with clients? What do you suggest people keep in mind as we watch these things unfold?
Yeah, I think the news we've had over the last few days is better than markets have been expecting, and the idea that the McCarthy now thinks they may have enough to put this in principle to the floor of the House suggests that a deal is in principle at least is there, and that's the market reaction we've seen, and that's the big sell-off you've seen in bonds the last few days, the equity market rally. I think what the market isn't really thinking about is what is the compromise that's going to be done between the White House and the Republicans in Congress, and that compromise is likely to be fiscal tightening. There's no way that the Republicans are going to agree to a deal that doesn't involve any form of fiscal tightening, and that's not going to be good for growth next year. It's not going to really be an issue in the near term, but it's not going to be good for growth next year. The other thing I think the markets are not yet focused on, because we're dealing with the relief that we don't have default in the US is that actually now the US is going to issue about $1 trillion worth of T-bills. And this is going to drain liquidity out of the system. So again, it's not really, in terms of the longer term, it's not particularly good for liquidity as you get greater pressure on bank reserves due to quantitative tightening, and in this case, from increased T-bill issuance, which will then be put back at the Fed in what's known as the Treasury General Account, which is where the Treasury deposit their cash at the Fed. That's gone down to zero if the Fed have used that as a form of extraordinary measures. So those are the two things the market's not thinking about. But right here, right now, clearly it's relief that the probability of a default is going down substantially.
And thinking, Myles, thinking about that fiscal tightening impulse, and that's a conversation a few guests have pointed out over the last few days. I mean, how significant is that going to be for an economy that, for many, is assumed to be slowing?
I think it's going to be, it is significant. There's no way around it. I think we look at the data and we see lots of evidence that monetary policy is restrictive. You see lots of that in the business surveys and capex intentions. You see that in terms of bank surveys, credit surveys showing that credit conditions are at sort of the typical peak tightness that you get in the economic cycle. And then to have fiscal tightening on top of that is, again, another factor that increases the recession probability. I think the issue with that is it's a bit down the line. It's not going to happen in the next month or two. It's going to happen down the line. But for a fixed income investor, I think these are the long-term factors that, to me, make bonds an attractive asset class when you look at what the market is pricing in terms of the interest rate cycle.
Talk a little bit more about what you're thinking in terms of fixed income returns. What is a good year looking like to you, Myles, if you're so positive on fixed income?
Well, I think the first thing is a good year is actually driven by the coupon they're getting on fixed income, which is up substantially from what we had a couple of years back. And if you think about what the rate hikes did to returns last year, it was actually negative capital returns. And whether the Fed raised rates once or not, I mean, I myself think we're going to be looking at cuts this year. That's not going to be a material driver, one or two additional hikes from the Fed in terms of total return. So I think that's the first thing, is you're getting a yield that's attractive in the order of 4%. For investing in global fixed income. And if you move into credit spreads, then you're looking at 5% and down to 8-9% if you go into high yield. That's the main driver of returns. The thing that makes me really excited, though, is the prospect of capital gains as the economic cycle rolls over and as the Fed cuts interest rates. And this is tricky in terms of calling precisely the moment, the timing of the first cut. But when you look at what the market prices over the next few years, you have a market that's pricing rates to go back towards just above neutral. And Fed say neutral's at 2.5%. The market prices rates at 3%. And I think the reality is that the recession means that rates are likely to be cut by more.
What do you think in terms of a recession and its impact on high yield, for example? Do you think investors are going to continue to flock to safety, or are they going to start to be comfortable with some forms of credit risk?
I think right now the high quality assets are the most interesting parts of the market, not the high yield sector. High yield spreads are not pricing enough of a recession risk premium. So if you think you're in a soft landing world, then fine, you can invest in high yield and capture that additional yield. But typically high yield spreads peak in a recession. And for us, the more interesting aspects are the higher quality things like agency mortgages, where those spreads are at their sort of secular wides in terms of the pickup you get over Treasury bonds. So right now, I think it's important to build a more cautious portfolio, owning core yields, owning high-quality assets such as agency mortgages. In Europe, you've got a similar phenomena you've seen with agency bonds, whether it's KfW or EU bonds, that have been driven a lot by what we've seen in quantitative tightening and the big increase in volatility from central banks.
We have been talking, of course, about the debt ceiling, Myles. We've talked about the year ahead, and we haven't mentioned the banking sector in the US and whether that comes back as a sort of risk consideration. Are you thinking that we are through that, or is this something we need to also keep in focus?
It does feel like the acute phase is over. It's very difficult to have high conviction about if another bank will or not go bust, but it does feel like the acute phase is over. So what I have more conviction on is the chronic issues, and that is that every bank liquidity has been tightened. It's been driven by quantitative tightening. It's been driven by the fact that retail depositors can switch from their bank savings accounts that pay about 0.5% and move into a money market fund that pay 5%. So liquidity, particularly in smaller banks, is being drained. And the issue is the excess reserves are not distributed across the system uniformly. And that means that those banks have to improve the quality of their balance sheet. And you've got a story today about the ECB stress testing liquidity there. So the entire banking system is focused on improving the liquidity of their own balance sheet, which means that credit is going to be more expensive for the real economy.
Myles, thank you so much for your time. Really good to speak to you. Myles Bradshaw of JPMorgan Asset Management. Thanks for joining us. Quick word on some breaking news just hitting the Bloomberg terminal. A red headline tells me that the Chinese PBOC vows to curb speculation in forex markets. It is urging institutions to maintain forex market stability. Wants to curb speculation on yuan rates when necessary. This coming from the Chinese central bank, and you can see the impact that this is having on a stronger currency, a stronger yuan as a result of these headlines. We will keep this in focus. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, an interview with Columbia economics professor Glenn Hubbard. That's at 6:30 p.m. New York time. This is Bloomberg.
Welcome back to Bloomberg Surveillance Early Edition. We just got that news out of the PBOC vowing to curb speculation in the forex market. And of course, that's pushing the yuan a little bit higher, a little bit firmer as we get towards the end of the Asian trading week, of course. What the backstory to this is that the yuan has been weak because of the weakness in the data that we've seen coming out of China. And so let's get into a conversation about where that Chinese growth weakness takes us. Annika Trion joins us, Van Lanschot Kempen's chief economist. Annika Trion, thank you so much for joining us. So, I mean, to what extent do you think that the Chinese reopening story perhaps under-delivering on some people's expectations? How much is that a weight on global growth right now?
Hi, Anna. Well, we've come from a long period where we were globally always relying on China to be this big pillar of supportive growth in all environments. And obviously what you see now with a very fragile global growth environment, with the big reopening story of China, obviously it's been quite disappointing that Chinese growth has been much more domestically driven and will be much less helpful in an already weak global growth picture.
At the same time, we have the DAX looking like it's on track for a record close, Annika, and part of that is to do with the Chinese reopening and the benefits that has brought for some European businesses. Are you still playing that kind of theme as you try to find companies and management teams that have a unique competitive position? How important is that China flow into Europe?
Yeah, well, you mentioned the unique competitive position, and I'm just going to zoom out really, really quickly and then zoom back into your question. But we've sort of taken this so seriously, we've actually dubbed it as our investment manifesto. And that means that whether we're stock picking, bond picking, fund manager selection, ETF selection, we always look for three principles. That's one, we're looking for a very strong competitive position, two, a very strong focus, and three, a very strong alignment. And to your point, Anna, I think it's not only about China, it's in general. Where are there companies, be it European companies, be it US companies, that have such a strong market positioning that are likely to, be able to enjoy their own growth trajectories with strong pricing power, et cetera, and be able to benefit from exporting to countries like China who are actively seeking their product or service.
When you're thinking about market liquidity right now, what are you thinking about how much risk there is that tighter financial conditions could lead to still more drawdown? Do you think that you need to position for a downside here, or are you positioning through the cycle?
Yeah, so I think you hit the nail on the head. So right now, the only thing we should be talking about is liquidity, because we're all harping on over and over again about recessions, inverted yield curve, more than a year of incremental negative leading indicators for the economy. But the reason that markets have held up, the reason why credit spreads are narrow, the reason why the VIX is rather moderate is because of liquidity, which has been quite strong. And to your point, you do see that faltering, whether it's from the banking sector because of tighter conditions, given the last few items that we've seen there, be it from a monetary policy perspective. So that's definitely the largest risk for markets, yes.
Well, you mentioned credit spreads here, remarkably calm. I think that has been confusing a lot of folks that have been watching the market. How much do you expect them to reasonably blow out?
It is confusing, but again, it boils down to what we just discussed, liquidity. So let's think about liquidity in the bigger picture. We've come from an era of 10 years of, whenever there's a problem, let's throw money at it, either from a monetary policy perspective or from a fiscal policy perspective. Low rates, quantitative easing, since actually 2008. We were entering into the new era of QE going into QT, going into tightening. And then you see three major central banks in the world actually halting their QT programs because of issues that have popped up, i.e. this addiction to liquidity that's really hard to get rid of, be it the Bank of England around the gilt crisis, be it the Fed around the banking crisis, be it Bank of Japan with their yield curve control. So to identify what's going to happen to spreads, we first need to identify what the path of future liquidity will look like.
Annika, thank you very much. Thanks for your time. Annika Trion of Van Lanschot Kempen joining us there with thoughts on the markets and the global economy. Coming up, Deere is out with its first quarter results. Before the US market open, more on what to expect from that tractor maker next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Shonali Basak in New York with Anna Edwards in London. Now we'll look at some of the stocks we're watching in pre-market trading in the U.S. We're looking at shares of Farfetch. They're soaring in pre-market after the specialty online retailer's first quarter results beat expectations on the back of growing sales volumes in the U.S. and in China. PacWest is continuing to gain from a relief rally in regional banks. And Applied Materials is lower after releasing quarterly results that unearthed weaknesses in the memory chip market. Anna.
Yeah, underlining that weakness then, and the stock down by 1.8%, as you suggest there, Shonali. Let's get to some corporate earnings that are due out imminently, very early stateside. We're watching Deere, which is going to be reporting results this morning. The farm equipment maker is expected to benefit from strong demand, but investors will be watching for its full-year profit outlook. For more, we're joined by Bloomberg Intelligence industrials analyst Christopher Cellino. Christopher, really nice to speak to you. So expectations seem to be high here. Are we talking about an industry that's seeing large agricultural equipment demand coming through with strength? What's the demand picture like?
Yeah, we expect a real strong quarter from Deere. Demand for large ag equipment remains healthy despite this recent deterioration that we've seen in crop prices. You also have more production days this quarter. Pricing continues to be remarkably strong, and we expect to see some improved productivity as the supply chain continues to normalize, which really should set the stage for a pretty solid quarter. And essentially all machinery companies have beat estimates this period, including their closest peers, CNH and AGCO, which both beat and raised. So anything less than a convincing beat here would be a disappointment.
Well, what are the risks then to such strong performance numbers expected?
Yeah, I think one of the areas of risk that investors would be focused on is their small ag business. This is one area I would say of relative weakness in the portfolio. It's the one business where they could miss expectations here, probably just given some of their consumer exposure and some weaker market dynamics. But that's really the one area of weakness. Large ag continues to be strong. Construction should be strong as well.
Deere shares have been down about 14% already this year. Are you saying that on the heels of stronger performance that the stock has maybe bottomed? A lot of this is due to so many recession fears.
There's a lot of concern out there that we are near peak earnings. So that's why you've seen a lot of these machinery companies have really phenomenal, even record margin performance this quarter and sell off. There's a lot of concerns that this could be as good as it gets. So any commentary that Deere could provide on 2024 or any kind of commentary about a prolonged large ag demand cycle will certainly be in focus.
And Christopher, what's been the link between higher crop prices, and that's been a feature of the wider effects of the war in Ukraine, of course. What's the link between those higher crop prices, which clearly benefit some of the businesses that Deere is supplying, and underlying demand that Deere sees?
Yeah, it's really been a supply and demand factor. Ukraine had certainly played an impact on why we have seen these elevated crop prices. But if you look over the past 3 months, crop prices are down 15 to 20%. We're starting to see favorable growing conditions. You have higher planted acreage, and the extension of the Ukraine export deal, combined with some slower economic growth, has really weighed on the recent performance of crop prices. That being said, they're still at relatively healthy levels and still supportive of farmers making investments in their equipment.
And what about inventories? What do they look like now, Christopher? Are you seeing a lot of businesses that sort of provide that middle service? Are they sitting on large inventories of this equipment or not?
So inventories remain historically tight, both on the new and used side, which we think is a positive and probably lends support to sustained strength into next year. It's going to take a long time for a lot of these inventories to be restocked, and we think that could actually even take another full year, even if demand is flat next year. So that's certainly one positive catalyst as we move into next year.
You've been talking a lot about next year and the forecast ahead. What can spook investors here? How high is the bar that they have to set?
Yeah, I think if we don't get any commentary on 2024, or if we hear some commentary around their early order program with disappointing or decelerating order rates, that might be a concern. I would even say if they even just reiterated guidance, that may even be a concern with investors, especially assuming that we do get a very strong print, which I would expect, just like everyone else has reported this quarter. Without that guidance raise, I think people are going to be a little concerned that maybe this is as good as it gets.
Christopher, thank you very much. Thanks to Christopher Ciolino of Bloomberg Intelligence to give us a preview on the Deere numbers. We're keeping across what is happening in Japan. The G7 leaders then, Shonali, meeting, of course, in Hiroshima, and we've been bringing you live coverage. These, in fact, pictures from, or images from just moments ago of the photo that is traditional on these occasions. G7 leaders then lining up for that photo opportunity. Itsukushima Shrine, I think, is what you see in the background there in the Hiroshima prefecture, which is where they've been having a tour and now have this group photo. They're going to be sitting down for a working dinner. They'll be doing that later on today or imminently. And a lot of the focus of the conversations then, Shonali, that's been taking place has been around Russia and their approach to Russia, reiterating they want Russia, of course, to pull out unconditionally, importantly, from Ukraine, and also tightening up on the use that Russia can make of international financial services.
Then, of course, that is that visit from Ukrainian President Volodymyr Zelensky. But, as we approach that visit, just take a look at that show of unity here, as you're showing, saying this, ceremonial picture being taken over in Japan, but certainly some big events set up for the rest of the weekend.
Absolutely. It has a lot of symbolism, doesn't it, with President Zelensky on his way there to address those G7 leaders. That is it for Early Edition. Surveillance is up ahead. They'll be hearing from Priya Misra of TD Securities, keeping the market moves firmly in focus. They'll also perhaps talk pound strategy with Jordan Rochester. I see he's going to be talking to the team. This is Bloomberg.